Liz, I just wonder if Powell's speech in Jackson Hole holds the key to not only this so-called disaster put trade, but the whole sort of tech thing as a whole. Like if Powell comes out and he surprises to the dovish side, or the market deems him to be dovish, the chances that you're going to get a pile into the broadening trade, I would suggest, are pretty high. Maybe the market right now is trying to sniff that out. Here we are, the Nasdaq's down 250. That's a little more than 1%. The equal weight S&P has outperformed the S&P over the past week. It's still obviously lagging over the last 3 months. But does Powell hold the key this week to this trade?
Well, first of all, I think there's going to be a lot of action before Powell even happens that probably doesn't have a lot to do with him. And the other thing that we have to lay the land here, S&P is trading in the 94th percentile of its historic valuations. I don't think it's a surprise that we're seeing elevated cost on puts, right? Elevated cost on protection. Now, the elevated cost on a disaster.
The difference of the cost in the spread.
Right.
From a bigger downturn versus a smaller one.
Correct.
That's at the spread that's gotten the attention of some.
That's right. And I think the reason for that, a big part of that, is that even if you look at what happened in April, there are two portions, if we really simplify it, two portions of return in the index. You've got the fundamentals, so earnings growth, and then you've got multiple expansion. You look at what happens when multiple expansion starts to take over as the lead return generator. If things turn in the other direction, multiple expansion evaporates in a heartbeat and actually takes a bigger hit than the rise that it previously saw. So I think that's the protection that people are putting on. I wrote last week about why to diversify, and this is exactly why. Number one, we're heading into a seasonally weak period. That's been an overdone story. We know that.
Worst month of the year, September.
But
over the last 10 years.
The problem with that, and I find seasonality a really weak reason to do anything, but the problem with it is we talk about it so much that we end up actually creating it in and of itself. So we have to watch out for that. Obviously, valuations are elevated. There are some liquidity concerns because the reverse repo facility has been almost drained, so the market could hit some financial tightening that isn't intended. And Powell is speaking on Friday, and in anticipation of a Fed meeting that's still to come. So right now, I actually think the market is overestimating the chance of a cut in September. And there is a chance that if he on Friday takes the optionality to say, you know what, I want more time, I want more flexibility, I want to see more data, I'm not going to confirm for all of you that we're cutting in September, I think that could turn things down.
Well, that's why
there
felt like, yesterday was a tremendous wait and see trade. And today's price action in the Nasdaq is interesting. A couple of days before Powell, I feel like B of A and their trading desk today is channeling this whole conversation, because they've given us a reason to even discuss it further along with this options trade. They list 3 reasons why mega caps are poised to cede their leadership. Okay, number 1, mega caps lag more than lead in easing backdrops. Hello, Powell. Our U.S. regime indicator shifts to recovery, where mega caps have lagged 2/3 of the time, and a shift into value and equity income is how they see the second half of this year shaping up. So the first one, if you're going to get a backdrop of easing, which I think we all kind of agree we're going to have a backdrop of easing. We're only arguing about, is it September or later, but the Fed's next move is likely to be easing. And thus you get a shift into value that speaks exactly to the rotation that some are looking for here.
Right, Scott. So that rotation, which there are many barometers for, I do use the relative performance of the equal weight S&P 500 versus the headline S&P 500. It's fledgling, that rotation right now. I mean, it's less than 100 basis points of outperformance over the last week. And before that, forget it. It is absolutely critically dependent, the broadening, the rotation, whatever you want to call it, on the Fed easing, on Chairman Powell indicating that September is a likely date to start easing again. Absent that, I strongly suspect that you will see flows go rapidly back to mega cap tech. Everything that's been said about the Palantirs, the IPOs are very valid points. And just extending on something that Josh said, if you look at mega cap tech, sure, the Mag 7 is trading at roughly 29, 30 times forward multiple, and maybe you say that's expensive, but bear in mind, this is also where the growth in earnings has been coming from and is projected to come from. So you're looking at mid-teens earnings growth year over year projected for the next several quarters. That gives a PEG ratio of 2.0. Some of the Mag 7 are a little bit more expensive. Don't really want to talk about Tesla. Some of them are cheaper, like an NVIDIA, which is the biggest stock in the universe, and it has a 1.4 times PEG ratio, which frankly is cheap.
Okay. Speaking of NVIDIA and these other mega caps, Morgan Stanley out with a note today, excuse me, that says mega cap tech stocks are more underowned versus the S&P 500 exiting the second quarter of 2025 than at any point in the last 16 plus years. NVIDIA is now the most underowned large cap tech stock, followed by Microsoft, Apple, Amazon, and Broadcom, while Intuit remains the most overowned name. Joe, you have spoken most recently about Apple being underowned. It is, and you can explain this for our viewers, it's counterintuitive, and I have the monitor of Josh in front of me, the large monitor that people can't see, where he snickered a little bit as I read that. Because when you read that and you say NVIDIA is now the most underowned large cap tech, or that mega cap techs are more underowned versus the S&P exiting this quarter than at any time in the last 16 and a half years, you're like, what? How's that possible?
Because people panic and react the same way. And through the course of market history, they have proven to be remarkably consistent. If you think about the fall, we went through that period where it looked like we were having what? The easing backdrop. And the market rotated. It rotated into areas like industrials and financials, and it moved away from semiconductors, and it moved away from mega cap technology. And then you moved into the early part of 2025, and you had that April Liberation Day massive shakeout in the market. And yes, it presented a scenario where you had a lot of growth managers who moved away from these mega cap companies. And very quickly, because the revenue growth and the earnings were present, they had to rebuild positions. And I've said there is no better example of that than what we have witnessed in Apple over the last 3.5 weeks, the rebuilding of position. We talked at the end of July about when we rebalanced the Quality Momentum ETF. I said at that time we were seeing momentum building for the very first time in the Mag 7, momentum that we hadn't seen build since the latter part of 2023. So it kind of all fits together, and unfortunately, it really reflects the emotional element and the deficiencies that we all have when thinking about investing, and we react to price. That's what we do, and that's exactly what's happened over the last 6 to 9 months. That's one of the reasons why you're seeing Apple move as aggressively as it has over the last several weeks.